Tempus AI just reported earnings, revenue up 36% year over year. They beat Wall Street, and the stock still dropped 7%. Here is exactly what happened and what it means for investors. Tempus AI brings artificial intelligence into healthcare. They help doctors make better cancer treatment decisions. They do this using one of the largest medical datasets in the world. This quarter, a clear beat on revenue and earnings per share. Full-year guidance was raised. The verdict, strong execution, but the market wanted more. Here are the numbers that matter. Revenue came in at $348 million. That beat the Wall Street estimate of $345 million. Growth of 36% year over year. Adjusted earnings per share, a loss of 13 cents. The estimate was 20 cents, a 35% positive surprise. Gross margin expanded to 63.8%. That is 310 basis points better than the same quarter last year. Full-year revenue guidance was raised. The new range, $1.59 to $1.60 billion. That is 25% annual growth. The watch item, GAAP net loss, was 70 cents per share. Adjusted loss was just 13 cents, a large gap driven by stock compensation and acquisition costs. Tempus sits at the intersection of AI and healthcare. On the AI side, their data and applications segment grew 40%. The insights business grew 44% year over year. Here is the most important strategic signal this quarter. Pharma partners are upgrading from one-off data purchases. They are now signing multi-year deals worth over $100 million each. Merck and Gilead both expanded their partnerships this quarter. That is a structural upgrade to revenue quality. On the healthcare side, cancer detection testing grew 500%. Still early, but the trajectory is exceptional. 3 themes from management this quarter. First, demand is real and broad-based. Oncology volume grew 28%. Management said they have never had this level of revenue visibility entering a year. Second, the pharma relationship is evolving. Companies like Merck and Gilead are no longer just buying data, they are building proprietary AI models on the Tempus dataset. That is a much stickier relationship. Third, the second half of 2026 is carrying a lot of weight. The full-year adjusted EBITDA target is $65 million. Hitting that number requires a massive back-half ramp. If that ramp slips, the guidance misses. That is the key risk to watch. 3 reasons to be optimistic. 1. Revenue growing 36% at a $1.4 billion run rate. Very few companies sustain this pace at scale. 2. $350 million in contract value is already locked in for 2026. Management has unusually high confidence in hitting their guidance. 3. Pharma partners are signing $100 million multi-year deals. That signals the platform has real enterprise value. 3 reasons to be cautious. 1. The stock dropped 7% after earnings despite the beat. The guidance raise was too small to excite the market. 2. Total debt exceeds $1.2 billion. The company is not yet consistently profitable on a GAAP basis. 3. The $65 million EBITDA target is heavily back-half weighted. Execution risk is real. Signal, buy on weakness. Conviction, medium to high. Time horizon, 6 to 18 months. The thesis, Tempus is building the most defensible AI healthcare platform in existence. The 7% post-earnings drop is not a red flag. It is a better entry point for patient investors. The company already has $350 million of 2026 revenue locked in. Next catalyst to watch, Tempus Investor Day on May 29th. That is the next potential re-rating event. This video is for informational purposes only and is not financial advice. Analysis is based on Tempus AI's public earnings release dated May 5, 2026. Wall Street consensus estimates were sourced from TradingView on May 8, 2026. Always do your own research before making investment decisions.